Ladies and gentlemen, welcome to the Cadence Capital Limited 2010 June webcast. I'd like to start this presentation by illustrating on slide 1 the performance of the All Ordinaries Accumulation Index relative to our portfolio exposure. I think you can see from those two charts on the first slide that we started the year with relatively low exposure and in actual fact increased our exposure fivefold over the financial year as markets improved and as they started to gain some momentum and earnings improvement. I think that that's quite for the year that we've just seen, it's really been quite an extreme year and our exposure has altered quite dramatically during the year. I'd like to go into how that exposure has altered by illustrating on the following slide the way in which we enter our long positions and the way in which we exit our long positions and how we enter and exit short positions. You can see on the top left-hand slide that we add to our long positions with 1% exposure at a time, and we don't add to a position unless it is going up. For example, we might buy it at $1, add to it at $1.05, add to it at $1.10, and again at $1.15. We do not average down into losing positions, accumulate positions that are already losing money for us, and increase the exposure of the fund into losing positions. On the right-hand side of the slide, you can conversely see how we exit long positions or how we accumulate and add to short positions. As a position exits a new high and falls 10%, we exit a third of our position or accumulate a new short position. As it falls 10% again, we exit another third and then a further third, or we might add to a short position by adding additional 1% exposures to that position. In this way, we reduce our exposure, either by reducing our long positions or adding to our short positions. The following slide shows our performance for the year and illustrates an outperformance of roughly 8 to 9% for the year. Our accumulated performance now also shows outperformance of around 8 or 9% per annum. And as we enter our 5th year of operations, we're pleased to be able to say that we've outperformed the markets by roughly 8 to 9% per annum. And I think that slide clearly illustrates the accumulated effect of that outperformance or alpha generation over a significant period of time. During that period of time, during this financial year, we have also paid out 6 cents of fully franked dividends, and our final 2-cent dividend was paid in the June 2010 month. An important point to illustrate is that our share price has also risen by 30% this financial year, and that is after the payment of 6 cents of fully franked dividends. So we can say then that the share price has actually outperformed the portfolio for the financial year, despite the payment of 6 cents of fully franked dividends. The following slide shows our sector exposure and how the portfolio ended for the year. Quite clearly there is large positions in materials sector, the bank sector, the diversified financial services sector, software and services, and we've tended this year to underperform in the utilities and transportation sectors. Breaking last year's performance down further in a stock-by-stock basis, we've ranked the stocks that have performed well for us from left to right at the top of the page. Reckon was our best performing stock, RHG our second best performing stock. Rio did very well for us. The Dioro takeover by Avoca was very good for us, as was the Customs position. Stocks that have underperformed for us during the year include Bravura and Transurban TCL. The following slide shows our top 10 positions as they ended the year by exposure, and the top 2 positions there being RHG and Reckon. Just by way of explanation, the RHG position started life as a 5% exposure position, and as the share price of RHG has risen, so our exposure has increased in the stock. As the stock performs better and better for us, so the exposure gets larger for us, hence the 20% position in RHG. I'd like to now go into the explanation for owning those top 2 positions, which are Reckon and RHG. The Reckon position increased in value for us during the period by 77% on a share price basis, and is a stock that over the last 5 or 6 years has produced in excess of 10% per annum earnings growth, in excess of 10% per annum cash flow generation and is a stock that continues and looks like it will continue to produce in excess of 10% per annum cash flow and earnings growth. In addition to that, the stock carries no debt, has excess cash, and is a very well-run business. Within its sector, it's in a position to increase prices, and it is increasing market share. And in actual fact, having just released their full year results, I feel that is probably one of the better results that we've seen over the last number of years. Reckon continues to perform well, and we continue to be comfortable with that position in our portfolio. The following stock we'd like to talk about is RHG. Our RHG position started the year at about 50 to 51 cents, ended the year at about 62 cents, and is currently trading at about 70 cents per share. In the December half year, the accounts show that the company had roughly 85 cents of cash in the bank and enough franking to cover that 85 cents of cash in the bank, so that the company was trading at a discount to cash in the bank and a discount to net tangible asset backing. We believe that the cash in the bank and net tangible asset banking at the June full year will be about 95 cents, and that the company's position to pay a grossed up fully franked dividend would be around $1.40. Now, as the company continues to generate cash through the runoff of its book, that cash will simply get larger and larger, and so too will the franking account. So we believe that over time, the difference between the cash in the bank, the NTA, and the share price should contract. RHG continues to trade at a discount to cash in the bank and a discount to NTA, and we remain very comfortable with that position. By way of summary and outlook then, we'd like to illustrate that the bottom-up approach that we've used, as well as the pyramiding into and out of positions in the manner in which we've described throughout this presentation, has worked very well for us this year, and we believe will continue to assist us to enter and exit positions and to generate performance for our fund members. Last year we illustrated and thought that the market would continue to be volatile, continue to produce some extreme valuations, and that has proved to be the case, and I guess continues to be the case at the moment, and that in the end patience will be rewarded. And we believe again, and would reiterate, that patience should again be rewarded in the year ahead. The stocks that should continue to perform well will be those with a strong business model, that have pricing power, generate strong cash flows, have some type of annuity or recurring revenue stream, and have a secure balance sheet with little or no debt. Conversely, companies that have a less secure business model, experience cyclical earnings, have high levels of debt, do not have pricing power, will find these difficult times challenging and will continue to find these times challenging in the years ahead. I think our job then will be one of trying to discern those better quality business models with better quality cash flow streams compared to those with lesser quality business models and less cash flow earnings potential. We remain relatively comfortable with our portfolio and look forward to the year ahead, and also believe that the year ahead should produce some additional opportunities, as it always does. Ladies and gentlemen, thank you very much again for your time in this June 2010 webcast. And should you have any additional comments or any additional changes or additional information you'd like to see presented in our webcast, once again, please do not hesitate to contact us via email or telephone. And in the meantime, we look forward to seeing you in the September AGM. Thank you very much.